Good morning, everyone, and welcome. This is Joe Scarice, co-founder and co-host of the Creative Birth Strategy podcast and Creative Birth Strategies house here on Clubhouse every Saturday morning, 8 a.m. and every Sunday morning, 9:30 a.m., providing education, insight, and strategy. So we're going to get ourselves set up here in just a few minutes, and we'll get rocking and rolling. Another busy week of discussions and meetings and events and coordinating, and it's a ton of things going on in our world. Um, Love to thank our sponsors first, of course. Like to thank Yordell Perkins of Perkatech, our social media strategist. Pretty much our Oz behind the drape, providing insight and strategic setups for uh, our social media analytics and insight out there on the web. I want to thank Linda Pelagas from Realty 411. She's our national publication and provides national events throughout the country. I've partaked in them throughout the country, from West Coast to East Coast. Has been a great ally in the real estate space for the last several years. I'd like to thank MB Capital, Mr. Eric Moss, who provides a referral partnership program for unsecured business lines of credit for real estate investors or business to business investors as well. And I'd like to thank Lendmark Capital, your asset-based lender that provides DSCR, fixed to rent, fixed to flip, multifamily, mixed use, asset-based lending products and programs nationwide throughout the country. And I'm a senior loan analyst there, and I've been there this past year. Very excited about where we're going with things. We're rolling out some great new products, which I'm pretty excited about as well. We'll discuss that briefly in the next few minutes. And our discussion today, what are market cycles in real estate? And we'll talk about some strategies and tips, of course, and get some insight, hopefully get some participation from um, you know, individuals that might have some questions in regards or statements in regards to this discussion at hand. I did put an article together just recently on LinkedIn. It was published on July 23rd, broke it down. So most of the publications that I put out, the articles, are tied into our upcoming discussions here on the podcast. So there's at least two articles posted on LinkedIn every Saturday and Sunday, every week prior to our discussions here. So if you follow me on LinkedIn or connect with me on LinkedIn, that's probably going to be a good spot to find the follow-up. If you can't hear the replay or download it from one of our social media buckets, the podcast itself, you can obviously look at the article that we wrote up. So I'm going to get started here in just a few minutes. I'm going to invite some people in just to get started. My thumbs don't work that quick this morning. Yordell and I went out to mastermind a little bit. We had a beautiful dinner down in South Philadelphia, and then grabbed a cigar, networked with a couple people, and then finished off at the Rim Cafe in South Philadelphia, which was a lot of fun. So we got a lot of good insight and discussions over the last several hours last night. Didn't drink too much, a nice little carafe of Merlot, but I kept it within reason so I could see myself this morning in one piece. There's been some weekends that, I could do the podcast, but I can't always drive. So, but last night was a nice, relaxing night. We had a great time talking with some real nice young men at the cigar shop, and we sat at the Rim Cafe in South Philadelphia, down near the official Pat and Gino's cheesesteak area, where everybody goes to thinking that's where the best cheesesteaks are, which is definitely not the case. But if anybody wants to come to Philadelphia, obviously we'll let you know what the better cheesesteak places to go to and hang out at. Um, Want to kind of update everybody. If you're watching this on video, you're officially seeing me wearing the official Creative Birth Strategy podcast shirt, which just came in. So we have now shirts. We'll be giving those away at upcoming events. We got the t-shirts. Next week are the coffee mugs, and next week we're going to get the backdrop as well. Which is going with our new logo. We're revamping the logo for the Creative Birth Strategies, and we'll put that out there probably in the next couple of weeks, just kind of finishing up everything. So I really do like the new logo that the guys designed. It's just giving it a fresh look. And we're going to be starting our masterminding event in September, second Monday of the month, 6:30. We'll be officially live on Clubhouse from 7 to 8 on Monday nights now. Additionally, we are having a happy hour wind down August 29th in Philadelphia at our offices at New Bold Exchange. Myself and Yordell will be hosting that. Then we're having a wind down first Friday at my wife's wellness center, first Friday in September, where there'll be chair massage and wellness and real estate and networking, which we'll have on the first Friday in Philadelphia. So you can make your way to Philadelphia, whether on a Thursday night or a Friday night, and stay over. You're more than welcome to join us and network and coordinate, and then we lead right into the mastermind events. We are coordinating those with a subject to group that's a subgroup out of Pace Morbies. It's called Subject to subgroup for Philadelphia. So we're going to do some coordinating with them on our masterminding event as well. So let's get into our discussion this morning. But first, let's get caught up on some articles this morning that caught my eye and a little update to the market. The market has been staying very, very interesting, meaning the rates have stayed below 7%, but probably in the high sixes, somewhere around between 6.86 to 7%. Now, the commercial rate dropped late Thursday, a quarter point, meaning starting base rate in DSCR is starting at 6.75 and up. Now, does that mean you can get a 6.75 rate? Yes. But is it at 80% loan to value? No. Is it at 60 to 70% loan to value? Yes. Is it based on a credit score of a certain criteria? Yes. But the rate is there. I've been locking some rates in at 6.75, 6.875. So rates, they even think in September, the Fed, obviously based on geopolitical push by the presidential run, they'll probably push the rates down a little more. I don't know how much impact that will have in our space, but because I think a lot of our hedge fund money is already buffered by about a quarter point. So we'll see how that all kind of rolls out. But interesting articles this week that caught my eye. The U.S. economic growth accelerated in the second quarter, grew twice as fast as it did in the first quarter, supported by consumer spending and pricing inventory investment. Furthermore, the data from the GDP report suggests that inflation is cooling. GDP price index rose 2.3% for second quarter, down from a 3.1% increase in the first quarter of 2024. Another article that caught my eye as well. Defining a buyer's market is always a bit tricky. Real estate experts say 4 signs to monitor. So 4 that you want to keep an eye out for as a flipper. Homes are lingering longer on the market. The average has gone up to a little additional months sitting out there. So you got to be very cautious about that. Buyers are backing out. They're finding ways to weasel out if the deal doesn't work perfectly for them. Sellers have more competition. And number 4, sellers are cutting prices. So you got to be very concerned about this, because if the property does not sell and you want to refinance and lease the property out, you're not going to be able to get the original price that you put the property up at. The appraiser is going to see that. They're going to see what you cut it down to. They're going to take the lower amount that you lowered the price to into consideration. So before doing that, or listening to some bad advice from your realtor, think about that from a lending perspective, because that's all tracked and the appraiser sees all those items. So that's a couple articles that caught my eye there. Interesting, another article, South and Midwest rank highest for rental affordability. Top 10 most affordable rental market cities and towns. Number 1, Austin, Texas. Number 2, Oklahoma City. Number 3, Birmingham, Alabama. Number 4, San Antonio, Texas. Number 5, Minneapolis. Number 6, Sandy Springs, Georgia. Number 7, Nashville, Tennessee. Number 8, Kansas City, Kansas. Number 9, Raleigh, North Carolina. And number 10, Norfolk, Virginia. We'll dive into one last article that caught Housing gathers dust on market as unsold inventory grows, as this kind of complements what we're talking about. It is a buyer's market, not becoming. There is a unique opportunity here and a window of lullness for the investor to grab onto some opportunities that are sitting out there. And I think we're going to see that at least for the next year or so, until we see some momentum based on the presidential election and where we are in January. So let's dive into quickly, and we'll get to our moderators, of course, how to navigate 4 stages of the real estate cycle. So, basically, market cycles in real estate refer to the periodic fluctuations in the market conditions characterized by changes in the property values, rental rates, and overall market activity. These cycles are influenced by various economic, social, and political factors and typically follow a pattern consisting of 4 main phases. Number one, recovery. This phase follows a recession or downturn. During recovery, the market starts to stabilize and property values begin to level off. Demand for real estate slowly increases as confidence returns to the economy. Vacancy rates start to decrease and construction activity picks up. Now, driving down some of the small corridors of Philadelphia, I saw a lot more vacancies in commercial space. Was definitely a concern of mine, seeing that in a very affluent area of South Philadelphia on Passyunk. So that made me a little nervous to see where that will go in time. That's something that you got to keep in mind in a lot of corridors throughout the country. Number two, expansion. In the expansion phase, economic growth accelerates, leading to increased demand for real estate. Property values and rental rates rise, and new construction projects are initiated to meet the growing demand. The market experiences high levels of activity with low vacancies and strong investor interest. I see a strong push for build to rent and spec development in the single family through 4 family space over the next 24 months, more so than multifamily. There's a lot more money on the street for single family development for investors, or 2 family through 4 family, than multifamily combined. So really keep that in mind. If you're really getting into the new construction space, there is a lot of opportunity there for you to jump into that market. Hypersupply, number three. This phase occurs when the market becomes oversaturated with properties. New construction continues despite signs that demand is waning. Vacancy rates begin to increase, and growth in property values and rental rates slows down. Market starts to show signs of overbuilding and oversupply. You're seeing that in a lot of the Northeast MSAs. You're not seeing that in the Southeast or Southwest, where a lot of the migration reports of affordability is where a lot of people are moving toward. Number four, recession. During the recession phase, the market contracts. Property values decline and rental rates drop. Vacancy rates rise significantly due to reduced demand. Construction activity slows down or halts altogether. This phase often leads to the period of price corrections and financial distress for over-leveraged property owners. Understanding these cycles can help investors and real estate professionals make informed decisions about buying, selling, and managing properties. Each phase presents unique opportunities and challenges. Recognizing where the market is within the cycle can provide strategic advantages. So you're starting to see vacancies. You're starting to see construction significance where people are not going in heavy into rehab. You're seeing rental rates dropping in certain markets and leveling in others. So you're seeing all this happening during this recessionary type of environment. Good morning, Melissa. Thank you for your patience. Brief overview, who you are, what you do, and thoughts to our discussion this morning. What are market cycles in real estate strategies and tips?
Hey, good morning, Clubhouse. Good morning, Joe. Thank you for having me up. I am Melissa King, owner-operator at One Last Eye LLC, Virtual Assistant Services. I offer realty, bookkeeping, notary, and office management services to small businesses and entrepreneurs. I am also a licensed real estate referral agent here in the state of Michigan, and I was licensed in Colorado, oh my goodness, 20 years ago. So yeah, I've been around real estate quite a while as an admin and office manager, and I can attest to the market cycles. I've been in both commercial and residential, and it does, I believe, obviously, is based on lending rates. Because you saw just a few years ago when they were super low, I mean, the real estate market was crazy. I've never seen it like that. So you do have to pay attention to lending rates, whether you're a cash buyer or not. It's market. That's what I got for today. I'm here to learn from you on the rest. Thanks, Joe.
Thanks, Melissa. How long does a real estate cycle last, right? Dating back to 1876, researchers have witnessed a predictable 18-year real estate cycle. However, in 1925, government regulation and other factors changed the normal cycle of the real estate market. Now cycles are much harder to predict due to several outside factors. Overall, the average real estate cycles last around 10 years. But, again, there's no solid answer. I'm almost thinking it's one presidential election to another. And some factors to affect the real estate cycle is obviously economic health, interest rates, like Melissa said, demographics, and government policies. And it'll be very interesting because obviously the media is steering a lot of the government policy rhetoric, which, I'm not a big fan of what's going on today. And I think it's impacting us in the real estate space significantly. And I think it only could get worse if certain things happen. But I can tell you for a fact from the advertising that we posted that the rates dropped to 6.75, I did see obviously a tick of people coming off the sidelines. I had one client alone. He's like, Joe, I'm ready to refinance 20 properties. I saw that you posted the rates dropped a quarter point, but I think the rates are going to come down a little further. I might want to wait till September. Hey, listen, you can wait till September, knock yourself out. It's okay. But how much lower can the base rate be if you're maximizing the LTV on the rent? So like if you're at 75 or 80% on a single family, you're not getting 6.75 or 6.86 in the conventional side. That's the base rate. So economically, your rate is going to be somewhere between 6.875 and 7.5, all depending on your credit score, LTV, and the debt service coverage ratio of the property. Okay. There's definitely significant changes by rate by an eighth. If your credit's below 760 or above 760 or below 740 or above 740. So you got to think about the logic to what you're doing here. What are you waiting for? If you need the money to identify other opportunities, it still takes 30 to 45 days to get that money in your bank. So if an opportunity presented itself today, now you got a bum rush to obviously to put the money together. So I always get a kick out of people doing the last minute thing. I need to close in 15, 20 days. Well, that might not happen. Have a common sense approach to the cycle. And if you need that money, start preparing yourself. I'm getting a lot of phone calls where people say, hey, I got a 1031 coming up. If I sell this property, I want to buy this other. How can I leverage? I had a conversation with somebody last night, going out with Yardell, kind of catching up on stuff. And I said, listen, you would be over leveraged at 75%, but I could definitely do this loan at 70%. You're going to have a little more money into the deal, but if you think you're going to spin off that much more money, you're going to make all that back in the next 24 months. Oh, yeah, that's probably right. I said, well, you're not going to get into this deal with just a pen. You got to make sure you got some skin in the game. And I had another conversation with a young man. He's like, somebody told me that if anybody tells you you can't buy a property with no money out of pocket whatsoever, they're crazy. Listen, I've been in the industry 36 years. I've still yet to not have to come to the table with one penny and just a pen. It's numerically impossible. So if anybody's selling you that horseshit, that is absolute horseshit. Where I would invest my time in understanding market cycles is sitting down with property management companies and see where they're going with their landlords and what they're hearing from their landlords on the tenant-landlord relationships. How's Section 8 working? How's the market rent working? Is it the same wherever you're thinking to buy or identify? What kind of money do you need to get into your first, second, or fifth deal or 10th deal? What is the reserve-based requirements? Those are the questions you should be asking to stay affluent and ahead of the market cycle at all times. Somebody asked me, again, another person asked me this week, hey, Joe, what do I do to start off? Well, do you have an LLC? No. Is your credit score above 700? No. Do you have 50,000 to 100,000 in the bank? No. Okay, so you need to get, first of the two things, let's get your credit score in place. And two, get your LLC in place. Okay, that's a good start. Call this registered agent, call Bob, get everything set up, and then let's get your credit above 700 and see how we can get you some extra reserves to get into the first, second, or third deal. Okay, that sounds good. Travis, good morning and welcome. Brief overview who you are, what you do, and thoughts to the discussion. What are market cycles in real estate?
Hey, good morning, Joe. Good morning, everybody. I'm Travis. I have a real estate brokerage here in the Houston market. And yeah, I like this topic. Me and my brother, but I got started in real estate investing like seriously in 2004. And at that time, man, I was reading all kinds of books about how to invest in real estate. And it seemed like everybody was telling me the same thing in their books, right? The whole you can buy it with no money down, do wraps, do subject twos, do this, do that, blah, blah, blah. But it was one book that I bought by this guy by the name of Mark Garrison, who actually broke down I guess you would call it the economics of the real estate cycle. And he would take people around the country and they would analyze the markets of all the MSAs in the country to determine where are they in that cycle. You know, are they in a depression and they're coming into an absorption market, and that's where they were looking to buy. And so anyway, that's how I learned about the market cycle, and that's the perfect one to buy in if you could determine that it was in a recession or a depression and is going into absorption, and because that's where you're going to make the most money as far as the price change of the property is when it goes from recession into absorption into a boom, and then you sell in the boom, and then go find the next market to do that in. So how do you figure out where the real estate market is? Well, that's not so difficult. One of the ways is just looking at the months of inventory that the MLS is telling you that's out there for that MLS area. So I was just looking this morning to see what's our MLS inventory right now in Houston, and we're right around 4.3% or 4.3 months of inventory for all of the real estate in Houston. So that's what we would consider, kind of a stable market. 4 to 6 months of inventory is what's been termed a stable market. So it's not a buyer's market, it's not a seller's market, but within that, you have to really dig down into the neighborhoods that you're looking at, because each neighborhood is going to have its own little market, and you need to know what that is. So it's really important to know where the market is, and know whether or not you want to get in, and if it's the right time to get in. It's kind of like buying stocks when they have all these different terms that they look at when you're looking at a chart. There's the head and shoulders and all this other stuff, and where is the stock price right now compared to where it's been? Is this a buy indicator or a sell indicator? So it's the same thing with the real estate market. Is the real estate market in a sell? Is it in a buy? Or what's your long-term plan? Do you even want to sell? Because once you start selling investment real estate, then you have to really think about, what am I going to do with the money? Am I going to pay taxes on my gain plus the depreciation recapture? Am I going to 1031 it? And if I'm 1031ing the money, what am I going to 1031 into if we're going into a recession? And so it becomes kind of tricky. Do I ever want to sell real estate? I don't know. That's kind of one of those questions you need to answer for yourself. But that's where guys like you, Joe, come in handy when you get so much equity in a property and you think, okay, I want to sell, like where I was at, and then the market turns on you pretty quick, and it's like, okay, well, maybe now I won't sell. Maybe I will go back and I'll refi the property and get my cash out so I can do something else with this cash and not pay taxes at all. Because that's what's great about pulling out your equity. You don't have to pay tax on the money that you pull out of your property, because it's not profit, it's debt. So anyway, I'll stop right there.
Well, Travis, thank you. And a couple questions come to mind. How long have you been in the industry overall?
So I started in 2004 when I bought my first house cash. I bought a foreclosure for 60 grand, bought tools, put on the tool belt, remodeled it myself, tried to sell it, never sold. And then I did a cash out refi and I've kept it ever since.
So 20 years. So you've been through technically 3 cycles in real estate for the most part, right? As a real estate agent. So, what if you could go back 20 years, what would you do a little differently that you know now, from a timing perspective? Would you have just held everything?
Yeah, I think I would have held a lot more. And just rode out the markets. And when I had enough equity, I would have pulled out more cash out of the properties and then reinvested that money. To when you get to the point where when you're going to start selling a bunch of property, like I'm helping some clients now that I manage their properties, to sell their properties and do a 1031 into something else. It's very tricky. You only have 45 days to identify, 180 days to close. You can only pick 3 properties, right? It's not like you can, in that 45 days, you've got unlimited number of properties that you can go buy. You got to identify 3. That's it. And if those 3 disappear, well, then you're kind of shit out of luck, right?
Oh yeah, I mean, I get it. I just don't understand why people are doing these type of renovations that are so tight and thinking they're going to flip in a market where the days on the market are increasing. I just don't understand who's telling them that they could turn this thing around real quick. You know what I mean? Who's giving them that advice? Who's talking in their ear? You know what I mean?
I don't know. Maybe nobody. Maybe they just, that's the direction they were started, and they want to finish. I mean, that's what happened to me in 2004. I wasn't mentored into flipping. It was long-term holds.
Yeah.
But I wanted to generate some revenue, and that's why I took that path. But anyway, I got all my money back out. So like you said, Joe, it's kind of hard to buy a house without any money. But I got my money in it, and then I got all my money out when I did the cash out refi. So it's possible to have nothing in it after you do the refi. That's possible.
Last night I was having a cigar with Yardell, and the gentleman that was there was a gentleman there that I know, and there was a realtor there, probably been in the business too long, Travis. One of those guys that have been like, 30 years. They want to tell you they've been in around 30 years, 40 years, whatever their story is. You know what I mean? And I'm listening, just paying attention. And the guy, his daughter got a bad COVID loan process, and they dragon tailed the back end of the deal, and now she's kind of like they're not letting her pay and get caught up to date, or they're charging her all kinds of money. Was a very predatory move, and so I said to the guy, I said, "Listen, I was listening to your colleague there. Don't know what he does. Oh, he's a realtor. So does he cure cancer?" He starts laughing. He's like, "No." I said, "Honestly, if you really want to try to fix what you're doing with your daughter with the house, how much is the place worth?" "Oh, at least 400,000." I said, "How much does she owe?" 200,000. I said, "Listen, why don't you do this? Why don't you put your LLC recorded onto the property, okay, and season it, and then just refinance it into an LLC, because right now LLC money is just as inexpensive as conventional money, and you don't need tax returns, pay stubs, W-2s, 1099s. It's like that exists. There's a lot of people that still sit in this bubble that don't really understand that there's a whole nother industry for the investor. It's this massive catch up. And the problem is you have these older school real estate people that don't stay abreast of the market and don't understand how to explain somebody through that. There's, instead of trying to like call the bank, that shit's done. You can't get anybody on the phone. Nobody's there. So, I mean, if you had asset-based lending 20 years ago, you probably would have held everything, right? Because you don't need tax returns, right? In the asset-based lending.
Exactly. And that, I've mentioned this before. Like we found a lender that did kind of asset-based, and that was that American Home Mortgage, where they were holding all the paper themselves.
Yeah.
So they said, yeah, you can have an unlimited number of loans.
Yep.
Like, holy crap. All right. We're going to keep going.
Yeah.
And so that's what we were doing. We kept using them until they were the first to go out of business in '07.
Oh my God, you just gave me like chills.
Yeah.
I haven't heard the name of that company because I think they were based out in the Midwest somewhere, and they had like 50 reps, and they were grinding out, commercial loans in the LLC, and then the whole thing went ba-boom.
Yeah.
And Mike, oh my God, I haven't heard that. I actually know somebody that worked for them. He's retired.
Wow.
That tells you how far back he goes. I actually
Yeah.
reported to him in one of my first loan officer positions like 20 something years ago. And he's like, yeah, I made a lot of money. I'm like, yeah, but those guys lost their shirt. He goes, oh, yeah, they shut everything down. It was crazy. So I think the problem is, I think people are so caught up with the shining object they lose sight in the short term of the opportunity of building relationships with people that and just do it like people that are becoming realtors now. I think half of them are looking for themselves. They're not looking for to be in the sales space anymore because they see the opportunity of creating generational wealth for themselves. Why help I've been helping all these other people. Why don't I just do it for myself? I mean, are you finding that it's not as you could when you're looking at opportunities, you're also looking for yourself now. You're not even really looking for the client anymore. Is that the case, Travis? Like in time?
Yeah, it is. I mean, I still look for clients, but mostly and since I started, it really was for myself and my partners. I wasn't looking to build a client base and help other people, but that just kind of happened organically. Um, the whole point was that I got my license so that I would be getting the commission when I would close on a deal. Like, why am I letting this other person get the commission when I'm basically doing all the work anyway? I'm doing all the research. I'm doing all the work. So, yeah, I mean that happens still. The agents that I have that work under my license, they basically do real estate for themselves. Like one's a commercial guy, the other one she does it with her husband, who's a general contractor. So um, it's a really good tool to have, and then you don't have to go out and show people at 6 o'clock at night and on the weekends when you want to be spending time with people you want to hang out.
Yeah, I get it. Well, thank you, Travis, for being here this morning. Strategies for timing investments. Timing is key to a successful investment. Understanding market cycles and indicators allow you to adopt strategies for timing investments. Number one, buy during a recovery. When you buy in a recovery phase, you are buying when interest rates and house prices are kind of on the low side. And now you're starting to see rates come down a little bit, enough to make really more sense of a deal. The recovery phase can bring significant returns on the market transitions to expansion. Look for houses are selling low in areas showing early signs of growth. I see there's an area that a lot of people are going after right now because people are getting away from it. That mixed use piece with the storefront and 2 apartments above, it's still a very sketchy market right now. But if you can come in with more money on the deal and ride this phase out, you might be able to buy a lot of properties at discount. I'm starting to see those properties being discounted to a point because they can't find financing. And in my space, mixed use is very difficult. It's a lot of moving parts. You're probably maxed at 65% loan to value. So you got to have 35% in on the deal. So it's really got to make sense. And you also, number two, have to capitalize during expansion. Focus on managing, improving your current properties, maximizing rental income and value appreciation of the property. This would be an ideal time to sell high performing assets before the market peaks. This also is about your business profile as well. Like Yordell and I are working on a podcast, we're working on websites, we're working on a mastermind event. You know, we're working on internal buckets. So it's not just about real estate, it's also about you and your business. So you got to capitalize and stay expansive in this market. And then number three, use caution in hypersupply. Don't negotiate new investments in hypersupply. And if you do, use caution. Soon a recession will follow and rates will rise. So be careful not to overextend your finances. So like we have this moment where rates are coming down a little bit. We still have commercial impact coming with resets and a lot of commercial vacancies. that's just not going to recover following a presidential election. So we really need to kind of prepare ourselves to some inevitables. Malls are in trouble. They're bringing apartment living to the malls. I mean, there's a lot of things going on that are changing the dynamics to being a landlord and what your competition looks like. And then obviously always preparing for the recession. Liquidity is vital during a recession. Maintain an emergency cash reserve to cover expenses should they arise. Patience is key as recovery will soon follow. Creating a diversified portfolio or revenue stream for investment types is important that could withstand a cycle. These are critical factors in real estate investment successes. When you understand the market cycles and monitor key indicators, you can make informed investment decisions. Strategic timing can increase returns, decrease risks, and ensure long-term investment successes. So, example, I have multiple revenue streams: investments, real estate, lending, private money lending, unsecured business line of credit referral program, insurance, property and casualty insurance referral program. I have an ownership in a title company. There's various revenue streams coming in. So I'm having a bad month one spot or a slower month in one spot. I'm making up the differences in others. Okay. So you got to balance yourself as a real estate professional. You're not always going to have a great month. You're not always going to have a bunch of closings, but you could be a referral partner and make revenue stream to keep the lights on. Justin, good morning and welcome. Brief overview who you are, what you do, and thoughts to our discussion this morning. What are market cycles in real estate?
Yeah, good stage in the book. Yeah, professional down, real estate professional down here. Southern Atlanta. A couple of things. Done some flips, done some builds, and man, some as far as the cycles. I guess I'm coming out of the stages of my first one. Joe mentioned it in his introduction that cycles, the nature of the cycle has changed. When I was a teenager, I would express my interest in possibly some form of real estate or something, and one way or the other to the people around me, or my parents specifically, my dad, he always remind me, "Oh yeah, son, real estate goes in cycles and blah blah blah." And that sounds like to this day that's one of the few facts that somebody told him one day. Now he does know a little bit more than that, but I'm just saying. So I've always heard that, and then when I got into real estate around 2011, we were coming off the backs of what you got, what's been referred to as 2008 crash and blah, 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 all of that stuff. So I was selling HUD foreclosures. So always worked with investors, been around investors and serviced investors. And I learned a lot then that, for them, for the experienced ones, it was a good time to buy. I did run across people from time to time who had the fear, what just took place 2-3 years ago, and all of those things, right? So I'm being exposed to both opinions, and there are two sets of experiences, and they often have to do with knowledge base and their experience throughout the last cycle. So how you were prepared, how you enter the cycle, and how and where you enter the cycle. And I'll just kind of skip to this. It's going to be, I believe, the most important element for you to plan for being a strategy. I didn't say get in at this point. You're going to be better off if you get in at that point. That can be debated, right? Depending on what point we're talking about. But regardless of when you do get in, your strategy should almost certainly, your acquisition strategy should reflect the moment of the market you're in. And whether you hold, flip, how you flip, and your strategy going forward should also reflect where the market is going, what it's looking like potentially. You don't have a crystal ball. No one has this. Probably heard this a billion times during COVID. But as the rules change, and by the way, I do believe there's going to be another sort of quick-ish cycle. And I don't know, I'm not going to say I believe, but I just know there's a chance, right? Because our society and the economics of that, that our societies are built on heavily involved in real estate. I mean, almost everything in some way, form, or fashion, it can be considered an exchange of real estate property, right? And so, with that being the case, I think that as we, vague word, evolve, but as we find different ways and methods to survive, as capital is controlled by different sectors of our society, and as we figure out better ways to live amongst one another and maintain, ourselves individually as strong individuals in the nation, financially or decent, right, or just try to maintain the little bit of structure and strength that we do have amongst one another. I'm not talking about America's bank account. Yeah, I'm talking about its citizens. So when we talk about that, I think there are a lot of shifts, ropes coming in different areas of the market and the different, um, arenas, whether it's tech, and they're making so many changes. There's a lot of opportunity for these folks to make money or those folks to make money. And these things can change or drive how that cycle is performing or acting at the time. And I just think we're in a place where there's just a possibility that the shift can keep shifting or shift in a different direction or make a move, especially when we're as sensitive as we are as a nation right now. The presidency and one way can go make a world of difference than another. And that one decision can also determine where our next cycle ends and the next one begins. So those are my thoughts, Joe. I won't take up any more time this morning unless you got some questions, but those are my thoughts and my experiences on cycles.
So Justin, do you have more of a scratch your head moment than ever now with clients or other fellow real estate agents that don't know their own property, like value, rents, taxes, insurance? Like, do you think there's a miss in knowledge base of one's own portfolio? I mean, have you learned from that to yourself?
Yeah, yeah. Oh, yeah. Shit, you know my personal, some of the personal obstacles that I've come across. But even throughout those things, right, using my expertise as an agent, as someone who's a student of, like, this stuff we call real estate investing, and you know, I mean, I find that all the time, but I find that when it was me doing it, I'll speak for when it was me early on in my career, 2016, 17. I was letting my optimism and my anxiety drive those thoughts. Those are mistakes. I mean, there should be. Those are considered emotional attributes. Those are emotional drivers. Those, you know, certainly don't really have a place, definitely not in the front seat of any decision making. I don't want to just write people off like that, right? Maybe they're misinformed, but usually when someone's misinformed, they're willing to be re-informed, right? So if they talk to you or they talk to somebody else who's a professional and they're able to give them some valid information, that should correct that misinformation. So, with the duplex, man, how long ago was that? That was about 7, 8 months ago. I sold that duplex in a panic, trying to get out, kept dropping the price, whatever. We just don't need it anymore. We're trying to do some other stuff. And so this week we're actually talking about those putting together those new construction duplexes or whatever. But the duplex we sold and we were trying to get from under, guess what? It's renovated. It's got a gated fence around it now. It's all white, fresh paint, and it's vacant at the bottom. So you spent more money than and you got a vacancy. So some things, Joe, they're risky, but we can put a calculator on risk, and so you need to fill in all the slots in your formula so that you can truly calculate your real risk, not your optimal risk. And that's what I think I got to say about that.
Yeah. Yeah, I think the investor, whether it's the real estate agent or the investor themselves or both, I think they're trying to underestimate to maximize the most amount of money on their deal in their mind. Meaning, oh, I only need to put 20 grand into this place and it should be fine. And then they get in there, and I can give you an example. One of my clients, he used 25 grand to do lipstick on the property. Finds out, he opens up wall number one, and there's termite damage from the first floor into the basement. Now, he's very well reserved. That's not the problem, but his repair numbers were absolutely wrong. What if he did not have that money? Why wasn't he using at least a 20% repair contingency? Or when a realtor calls me and says, hey, I got a client that wants to buy this property and they want to put 50 grand into the place. They're going to buy it for 200. I'm like, what's the after repair value? Well, I'm not really sure. You're the realtor. I'm the lender. I mean, I can look up, but I'm a licensed realtor, so I'm able to look up and comp the property. Why am I able to do that? And you're the individual that's supposed to make a commission. Now, guess who the only person you're going to blame if those numbers don't come in? You're not going to blame yourself. Who would want to blame themselves? Nobody wants to blame themselves anymore. They want to blame everybody else. Oh, it's the lender's fault or the title's fault or the insurance agent. It's never the person that came up with the numbers and gave them to you. Do you know how many more disputes I put in on appraisals because people think their houses are obviously worth more than what they are? Now, do appraisers make mistakes? Absolutely. But if the comps are what they are, how do I create a new comp? Well, can't you use the income approach on a two-family house? My friend, it's a residential property. You use the income, a part of the income approach when it's a multifamily building that's worth $1 million and above. I can't use the same mindset or approach to finance the way that you want. You can't jam a square peg in a round hole in a market cycle where values are leveling or coming down, rents are leveling in some areas or coming down or going up in certain areas, but values are not going up with the rents because the comps got to justify. So you have to understand housing market trends. It's influenced by a lot of factors. Are you looking at Mortgage News Daily every day and reading 2 or 3 articles? Are you going onto other sites like Bloomberg or MSNBC or Squawk Box and watching and listening to trends and listening to things on YouTube on the economy to stay abreast of it? Or are you depending on other people to give you advice? I get a kick out of the individuals that go into their offices and I say, I'm just going to get my advice from all the other people in the office. So you're just going to be like a gnome and not get any based opinion for yourself. So you need to understand the economy in your region or your local markets. Where's it going? Like I obviously went out to dinner last night, but I wanted also to see what a very affluent corridor was looking like. I saw coffee houses that have been around a decade closed, stores vacant in certain areas that didn't make a lot of sense to me. And I'm like, okay, I got to keep an eye on this and what this. There was a men's clothing store that's been around since the age of time, closed for rent, gone. Now, are interest rates a factor? Absolutely, especially in the mixed use commercial space. In the residential space, it's all about the cash flow. It's all about the DSCR. It's all about the lease. It's about the lack of interest in home ownership and the increase in allowing other people to take care of the renter now. And housing supply. Do we have enough rentals? No. But do we have an influx of inventory and real estate stock on the market? Yes. Is this influenced by the government on bad decisions on behalf of our democracy? Yes. Was inflation created by us individuals? No. It was created by government giving millions and billions of dollars to everybody else other than their own country. That's a fact. You can make up whatever story you want, but that's the truth. Okay? No matter what party line you fall over, you can't debate with me on that. You got to understand inventory levels. You got to understand also demographics. Who are you trying to rent to? The 25 to 35, the 55 plus? Where are those markets? Where are the government policies coming into place to create or reset market cycles in your areas? Tax code changes, housing market cycles and crashes, expansion, hypersupply, recessionary with vacancies, recovery with no new construction causing vacancies to decline. How do you analyze a housing market? When's the last networking event of education you went to? Not a sell-a-thon. Like if somebody's offering an event, say, hey, buy houses for $1, that's not a place where you get educated. That's a place where you get sold. Horseshit. Yolanda, thank you for your patience. Brief overview, who you are, what you do, and thoughts to our discussion this morning. What are market cycles in real estate?
Great morning, everyone. Thank you, Joseph. Hey, West Michigan, Melissa. Buy and hold, Travis, Louisiana, Justin, and everyone else in the room. Happy Saturday. I'm Yolanda Smith Charles, also known as Yolanda Sells Michigan on all social media. And I was always enjoying conversations on these Saturday mornings. I wanted to chime in on a couple areas with regards to the market cycles. I'm someone newer in the business, and obviously the cycles that I've witnessed are smaller and fewer. Obviously, I've been alive, so I've noticed changes as a consumer. But in terms of real estate speak, in fact, an article just popped up that I was perusing while listening, came from Fox 2 Detroit News, where it says, where Detroit newcomers are coming from. U-Haul study reveals where people move from, which, one of my beloved Clubhouse friends here, the New Agent Handbook, talks a lot about movement trends, migration trends and patterns and things like that. And if someone would have asked me an hour ago, are people moving to Michigan? I'd been like, hell no. No one's moving to Michigan. But this article obviously indicates different, and it talks about like where those people are coming from. No surprise, Ohio, because Ohio totally sucks. But also Indiana, Illinois. So it's unique that Florida was on there too, Tampa. So again, just keeping that in mind. But something that you had mentioned earlier when the room first started, Joe, was about there's a buyer's market somewhere. And that's still not the case in my market. That's still not the case in Metro Detroit. Like there are few properties when you're running comps to compare. I'm having to go back a year because so few properties are transacted in these areas that I've been looking when I'm helping my sellers decide like what to price their property at. And so I still believe that real estate is still very much local. In my intro, I should have mentioned I'm a realtor. A budding investor, and also an elected official. I am on my county board of commissioners. You can Google me, as they say. And I can assure you that from the policy side, we're like, hey, developers, where are you? Come to Oakland County, come to Michigan. We want to give you incentives and reasons for that. And so the connective tissue there with finding builders and developers who actually want to do something on, let's say, the affordable side is still, it's kind of budding. But I will say that the national policy on home ownership has found its way to the grassroots level where we're like giving money away to millions of dollars to encourage people to come and invest. So in terms of cycles, my mind looks at it like a big fancy clock with a whole lot of things spinning. Those are all different cycles happening at once, making the clock go, tick, tick, tick or whatever. So that's kind of where I'm at in the Metro Detroit space is it's still every bit of seller's market. And yes, homeowners are disenfranchised on what their home is really worth on the market, but nonetheless, it's still a great time. So thank you for the opportunity to chat.
My pleasure, Yolanda. Thank you for your insight. My thought on affordable housing comparatively to more of a Class B or B plus rental market. The cost to build or renovate is the same in either one, in my mind. You know, I mean, a 2x4 it costs the same amount of money whether you're using it for a Class B A rental or a Class C or D rental. 2x6 sheetrock, metal framing, roofing stock. What needs to be addressed more so, instead of sending trillions of dollars internationally, is using that money to capital stack and provide monetization to the debt for investors to come in, build and renovate, where when they refinance, when the cost is dead the same, they're able to still be able to recover their debt and provide affordable housing for that sector of need in those demographics. And that's pushing toward the middle of this country right now, because affordability in a market cycle right now in the Northeast is just not working for a lot of people. But I feel no matter what market you're in, whether it's a seller or buyer's market, there's opportunity anywhere, everywhere, because I think one way or another, somebody's always in distress. Somebody's always got a problem. Somebody always is passing away. Somebody's always getting sick, or affordability, or families are shape shifting. I think we are in a mild U.S. recession. I think the media is obviously putting a shower curtain in front of it so you can't fully see it. I think we have to work that much harder to justify our standard of living. And I think real estate professionals, however you want to label yourself, have to be that much more strategic and that much more precise to be a better professional for whatever they want to do. Now, for a realtor, a realtor or real estate agent, whatever you want to call yourself. And I don't know. I know I'm a real estate agent by accident kind of thing. I've been licensed since '88. I'm still trying to figure out my place as a real estate agent. I feel you definitely need to diversify yourself between home buyer and investor. And the acceptability of being investor friendly and understanding that, I think is more important right now than understanding the home buying. I think it's more of a 50-50. Is there loyalty in either one of them? No. I think the consumer that lives in the bubble, they'll follow the shiny objects. The same with the investor, they'll backdoor you in a split second to avoid paying you a commission. So you're in kind of an evil quandary. So I do like the Detroit market. I think there's got a lot of room to grow there with closed, obviously they blocked off areas where they don't even have utilities run and things of that nature. There's an opportunity when you got bare land, developers could build, as Will Rogers said, you can't make more land. So I think there's an opportunity. I mean, the skyline of Detroit's beautiful when you're looking at Canada. So that I like that market. I think it's a very cost-effective and barrier of entry. I think that demographic there is that 25 to 35 and that 55 plus. People though want to see lights and restaurants to be able to move and rent if a developer is coming to do something like that. So that's very key. And I draw that relevance to Detroit, to like Atlantic City. You got this $1 million waterfront where there's a walkway and there's all this empty land. Like what's going on? Let's put a pavilion there and put rentals and restaurants and lights and police and protection and security, and you'll have that demographic. But the politics typically and traditionally have always gotten in the way. So that's where market cycles are impacted the most, when government kind of gets in their own way. Some governments stay at the side and allow progression. I've seen that in the Lehigh Valley, more so in the last 5 years than the previous 20, which I'm very impressed what's going on up there. I drove through there recently, and I'm really impressed what's going on in some of the markets there. So let's get some outros. Melissa, your outro and brief thought to what are market cycles in real estate.
Hey, thank you, Joe. Melissa King, One Last Eye LLC, virtual assistant. Wow, what great stuff here today. And it is local, interstates, everything you said here. It's a long game, so I'm looking forward to more.
Thank you, Melissa. And by the way, I did see your video I got to hear you actually see you in person on video, by the way.
How do you like that?
Very impressive. Very impressive.
Oh, great. Thank you. I appreciate that.
See, I was one of your views.
I'll have to go check those. I am camping right now. That was one of the last things I did before I hopped off. Or I should say glamping, excuse me, next to my little fire here.
Sounds good. Travis, your outro in regards to what are market cycles in real estate.
Yeah. Okay. Yeah, I'm Travis, a real estate brokerage here in Houston. I would say that to anybody who is investing and I'm sorry, I didn't hear what other people said because I lost my connection here, or thinking about investing, is they should really understand the market cycle that they're in currently and what the strategy is for that cycle if they're going to invest in that market, and to know that the market is hyper local. It's not, I told you that the months of inventory for the whole city of Houston, the whole MSA is 4.3 or 4.4 months. But if you start digging down into particular areas, that's going to change. So you really got to dig down and get pretty granular as far as where you're going to invest and where is the market in that area. That months of inventory is based on the last 30 days closings, right? So they're looking at what happened last 30 days. How many homes were under contract and closed, and compared to what we have available, this month. So you got to look a little bit closer to that. You got to look at, are there any homes that are currently pending? Has anything changed in the last 30 days? So you got to really dig down and know what you're getting into, and work with people who know what's going on. Don't just work with your friend because they have their real estate license and they have no idea about investing in real estate. You should really grow a team, like Joe has said so many times in the past. Put together your team and then go buy. That's my 2 cents on this show. Thank you.
Thank you, Travis. Justin, your brief outro in regards to what are market cycles in real estate.
Yeah. You definitely, there's been a lot of good stuff said, but you definitely just need to really be a student of your plan. Study your plan. Have your plan in place. Where are you trying to go? Why are you doing this in the first place? I think it always comes back to that. And then you begin your studies. Not then you begin, but you continue your studies in a more focused fashion based on what you. And your studies, you'll find out where you are in the market. It may not have a name, place, or date on it, but you will find out where you're positioned strategically and how you need to move. And that's my suggestion for how to move in any market. And great speaking.
Thank you, Justin. My question to anybody that's listening to this or on the replay or on the podcast, why haven't you reached out to these 4 moderators to have a strategy discussion? That's my call to action to you is they all just brought some serious diverse thoughts, unscripted to this discussion this morning. A very solid 16 minutes. I want to thank everybody. I'm a big believer in building out your power team and keep rebuilding, building that bullpen, having deeper discussions with your client base, following up, doing check-ins, little pokes, see how people are doing. The follow-up, the consistency and continuity as a real estate professional, you will far exceed anyone else. The turtle will always beat the hare in every storyline in real estate. I want to thank our sponsors this morning. Again, Mr. Yardell Perkins of Perkatech, our social media strategist. I'd like to thank MB Capital, our unsecured business line of credit referral program. I'd like to thank Lendmark Capital, your asset-based lender for DSCR, fixed to rent, fixed to flip, new construction, multifamily, and mixed use. And I'd like to thank Realty 411 with Linda Pelagas, your national publication for real estate professionals, as well as providing national real estate events of education throughout the country. My quote this morning to think about: 10 things that require zero talent. 1, being on time. 2, making an effort. 3, being high energy. 4, having a positive attitude. 5, being passionate. 6, using good body language. 7, being coachable. Number 8, doing a little extra. Number 9, being prepared. And number 10, having a strong work ethic. Everybody have a blessed Saturday morning. We'll be back here tomorrow morning at 9:30 a.m. Eastern Standard Time on Creative Birth Strategies House and podcast. And thank you. And I'll be ending the room in the next 30 seconds. Have a great day.